So, everyone, thank you so much for joining us for our Tampa Bay Business and Wealth Virtual Connect. We will call this number COVID because it has done that to our brains. We have forgotten everything and how many of these events that we do over the past 6, 8, who knows how many months that we've been playing this fun game. But thank you for joining us. We appreciate that you're here for a great discussion. We continue to offer these events through the virtual world to continue offering valuable content and information to all of our audience and our partners through the crazy times that we're in. Tonight, our topic is a fantastic one: tax implications of the election, being that it is right around the corner. Some very important information that those running businesses and who are investors can really use as they move forward in making decisions, so on and so forth, as we finish out this year and moving forward into the future. Please always remember that the content that is addressed today, it is facts. It is researched facts from some very, very good people who really know what they're talking about, better than I do, that is for sure. The views expressed here are not necessarily those of TBBW or its employees as we roll forward. The discussion is intended to be very, very, very bipartisan. Ground rules. Everybody will be placed on mute before we start a discussion, as always. The best way to view this forum is in the speaker view up top. That way you only see the person who is speaking during that time. Please feel free to use the chat, talk to each other behind the scenes. You're going to see some people you may not have seen in a while. So feel free to do a little chat behind the scenes and say hello. Also, Jolynn will be monitoring that chat window if it's an open one to look for questions that if we do have a chance to get to them at the end, but we have a lot of content, we might not be able to get to those. If we do have a chance to get to some of those, then we will try to filter some of those in as we move forward. As always, stick around after the conversation, after we're done with our panel discussion, because that's where some really good, lively conversation and some networking takes place. Grab a cocktail, have some fun, say hello to some folks. A lot of our panelists do stick around to answer some additional questions, but make sure that they are nice questions and related to the topic. So again, just please be respectful to our panelists. And with that, thank you all again for coming today. We really appreciate having you. I'm going to pass it over to Bridget Bello, our lovely and awesome CEO and publisher.
Thanks so much, Jason. I appreciate the kind introduction, as always. My name is Bridget Bello. I'm CEO and publisher with Tampa Bay Business and Wealth magazine. And based on who I saw is on this call, this topic is going to have a lot of implications for all of us. We are a CEO-focused, centric publication, and the people on this call are the business owners and presidents and CEOs in this community. So hopefully you will be a much more informed voter once we're done. I want to do a special shout out to the panelists that are with us today. We have Jeanine Blake. She is Principal CEO for OppZone Capital. Derek Harley, he is SVP of Federal Affairs for Shumaker Advisors. And Carlos Rodriguez, SVP and Wealth Strategist for Bank of America Private Bank. So we're going to get into this pretty quickly. You do have the opportunity to submit questions in the chat, but as Jason said, please be nonpartisan and kind. We are not here to have a political discussion. We're here to have an implications discussion. So you guys are always respectful, and we expect you to be the same way. So I'm going to jump right in with a question for Derek. Derek, thank you so much for being here and for being part of this conversation. He's coming to us all the way from Toledo, Ohio, where it's not nearly as pretty as it is here in Tampa Bay. Derek, why don't you talk about what the tax agenda would look like in a potential Biden administration, and then also about a second Trump term?
Sure. Thanks, Bridget. And my pleasure to be with everybody today and kind of kick us all off. And I was going to say greetings from cold, windy, and rainy Ohio. So welcome to on the cusp of winter. It looks like a lot of you are sitting down there in sunny Florida, so I'm jealous. But as Bridget indicated, my name is Derek Harley. I'm the Senior Vice President of Federal Affairs for Shumaker Advisors. We're a government relations and lobbying arm of the law firm Shumaker, Lupe & Kendrick. We have offices in Columbus here in Ohio, also down in Florida, Sarasota, Tampa, Tallahassee, where we do a combination of state and federal work. And I call myself the on-the-ground presence for the firm and our clients in DC. I'm based here technically in Ohio, but I'm in Washington most weeks. The House and Senate are in session. Kind of gives me an advantage of being in both places at the same time to serve our clients out here in Ohio, but also be in DC where the action is. And very briefly, my background, I served for a little over 20 years as a staffer on Capitol Hill for the U.S. Congress, was the chief of staff for two members of Congress, most recently Congressman Brad Winthrop from Cincinnati, Ohio. Both members served on the House Ways and Means Committee, which some of you know has jurisdiction over healthcare, taxes, and trade, amongst some other issues, and was on the Hill in the House when Congress passed the tax reform plan, the Tax Cuts and Jobs Act, or the TCJA in 2017, which, as you'll see, will underlie a lot of our discussion about here today. And taxes, of course, are an incredibly important issue anytime. It's something that affects each and every one of us, but it's especially so now with the election just a week away and the potential for a big change in direction. So first, I'll just kind of hit some high levels of the potential Biden administration if he were to win, what their tax plan looks like, and I'd say in a word, higher. Though he has stated that their plan will not impact anyone making less than $400,000. They've really made pains to kind of make sure that they would target high income earners. I'd say that's probably debatable and something we can talk about, but that technically is correct and kind of the basis of their plan. And it's fairly detailed, and from the reports I've seen, it's a pretty high priority for them if he wins, though it's unclear to me at this point when and if what form that will be passed, and whether, or what they'll try to pass, and whether it will be tied together with other policies. And of course, if he does win next Tuesday, his ability to pass that program or the news policy changes will depend on whether the Democrats also win back the Senate majority, which of course is unclear at this point, and something we can delve into later if you'd like. So here's a quick couple of highlights of his plan, and maybe Carlos can fill in if I miss anything. Increase in the corporate income tax rate from 21% to 28%. You'll remember that the TCJA had reduced the corporate rate from 35% to 21%. It was a goal of Republicans back then to get us below the OECD average, which we accomplished, but this plan would take us kind of back up to about 28%. It imposes a 12.4% Social Security payroll tax on income earned above $400,000. Again, there's that $400,000 figure split between employer and employee. And it would actually create a kind of a donut hole of sorts between the current cap of 137.7 and, of course, that 400,000 number. It would revert the top personal income tax rate to 39.6% from 37%. Income levels, again, above 400,000. It phases out what's called the qualified business income deduction, which is the Section 199A, again, for filers with taxable income over 400,000. Now, this was what was put in the TCJA to kind of duplicate the corporate rate reduction on the personal pass-through entity side. But that, as we can talk about too, that actually is scheduled to expire anyway after 2025. So they won't capture too much, savings on that side. It also creates a 15% corporate minimum tax for corporations with, quote, book profits of 100 million or higher. So this is structured, looks like a kind of an alternative minimum tax for corporations. And I think two things that are of note. He's proposing a new 10% surtax on corporations that, quote, offshore manufacturing and service jobs to foreign nations in order to sell goods or provide services back to the American market. So it's not very detailed, something like that. Lots of policy needs to kind of be put on those bones, but that just goes to where this kind of the notion, actually a little bit of a bipartisan agreement, although I'm not sure that there'd be bipartisan agreement on the approach, but trying to bring those jobs back from overseas. This is kind of more of your stick than carrot approach. But in that vein, he also proposes a 10%, quote, made in America tax credit for those activities that kind of restore production and bring job growth here in the U.S. So those are some of the high level details. There's more to it, and I can offer some resources if anyone wanted to dig into it. I say a couple other high level points. One, there's talk about, maybe potentially eliminating the Senate filibuster, which is the threshold that requires 60 votes in the Senate to get anything done. I'm not sure on something like this that they need to do that, because just like Republicans use a tool called budget reconciliation back when they passed the TCJA, it's a kind of an arcane budget tool that only requires 50 votes in the Senate. So they technically could use that to try to get these things through. I'm also not sure it's going to be a huge priority right out of the gates. I think in January, if he were to win and they get Senate control again, you'd probably see COVID relief, that package probably up first, and then maybe later. And then I think that they probably would couple it with some other spending policies, maybe transportation, maybe something on the climate or the environment, because they're talking about, this plan would generate potentially $3.3 trillion over a 10-year budget window. And with some of their spending plans, I suspect they might want to kind of turn that revenue into some of those priorities. So, and real quick on the Trump tax agenda, if he were to win and again kind of hold the Senate, there really aren't a lot of details. I mean, he did propose an agenda right around the time of the convention back in August under a couple of broad headings: jobs, ending our reliance on China. Those details, again, kind of a Make in America tax credit, similar to actually what's in the Biden plan. It mentions opportunity zones, which I know we're going to talk about. There's also that from potential of forgiving the payroll tax relief or the forbearance that was decreed here kind of administratively toward the end of the year. And then, unfortunately, he doesn't mention the expiring individual tax provisions that were in the TCJA. So again, not a lot of meat on the bones here. And if he were to win, I think you'd see a lot of interaction between him and the tax writing Republicans in the Senate and House to kind of fill in some of those gaps. But I'd see priority probably on the individual tax side, finding something to do to extend those expiring provisions, maybe something on the Made of America credits or other incentive side, and then probably some work on opportunity zones.
Great, thank you. That's actually a great segue to Carlos. Carlos, I was going to ask you how the current federal tax law passed under the 2017 Tax Cuts and Jobs Act compare. So Carlos, take it away.
Thank you, Bridget. Good afternoon, everybody. As Bridget said, my name is Carlos Rodriguez, wealth strategist with the Bank of America Private Bank. I've got over 25 years in the wealth planning industry, based here in Tampa, but I work with high and ultra high net worth clients throughout the Tampa Bay and Southwest Florida markets. Before I get into my background, I just want to, again, thank, on behalf of the bank, the Tampa Bay Business and Wealth magazine, for the opportunity to sponsor and to participate on this Virtual Connect panel. A little plug here for Bank of America. As many of you may or may not know, it's not only one of the largest banks in the world with 8 lines of business, but through the private bank, we actually are the largest provider of personal trust services. And the private bank has over 100 offices throughout the country, where we deliver, almost a boutique private bank experience for our clients, but with access to extensive intellectual capital and resources of a large financial institution. And real quick, my background, I am a tax attorney, practiced for 6 years here in Tampa, and then joined another financial institution in a role similar to the wealth strategist role that I'm in now. My educational background, I went to USF for business administration, went to Florida State for law school, and then got my LLM in tax law at University of Florida. So in my role as a wealth strategist, I work with our clients and their outside attorneys and tax advisors. I do not take the place of outside legal or tax advisors. I'm a complement to those individuals. So getting to the question, how does the current tax law compare to the what we believe to be the Biden tax plan? Well, under current tax law, as Derek touched on, back in 2017, with the Tax Cuts and Jobs Act, the top income tax rate was reduced from 39.6% to 37%. And certain deductions were eliminated. The miscellaneous itemized deductions were suspended. The exemption for federal estate and gift tax, which at that time in 2017 was a little over $5 million, was basically doubled to over 11 million. Right now, it stands at 11.58 million per person. That's the exemption from the federal gift and estate transfer tax, which applies at a 40% tax rate once you exceed those exemption amounts. The other part of the tax plan really just kept in place the fact that when our wealthy individual passes away with appreciated assets, that the cost basis of those assets gets stepped up, if it's appreciated, to the fair market value at the owner's death. So survivors, when they inherit a stock or real estate, they can turn around and sell it and likely not have any capital gains tax. Well, that's something that the Biden tax plan is going to attack here, and I'll mention that a little more about that shortly. So again, top tax rate 37% currently. How does the Biden plan compare? As Derek mentioned, the Biden plan, we don't have a lot of details, but in outline form, as Derek said, he is looking at, I want to say attacking, but targeting high income taxpayers above 400,000. So whereas under the current tax structure, somebody making over 400,000 is probably in about the 33 or 35% bracket. Under the Biden plan, they would be close to the 39.6% bracket, which would be the top bracket under his proposal. The other thing that the Biden plan is going to do is potentially double the rate on long-term capital gains and qualified dividend income from the current basically 20% for high-income taxpayers to almost 40%. And that increase would apply to taxpayers making $1 million or more. So that's one situation where he's not necessarily targeting 400,000 in income. In that case, with the capital gains and dividend, it's going to be $1 million or more in income. The other thing that he's going to do or proposing to do is to eliminate the step up in basis that I mentioned earlier. So whereas currently and for years, survivors have been able to inherit property and then turn around and sell it soon thereafter the owner's death without any capital gains tax, that may be going away. Again, it's a proposal at this point. The other part of the Biden plan, which is at this point is purely speculation because there aren't a lot of details, but most experts believe that the current estate tax exemption of $11.5 million per person, which for a married couple means that you can shield about $23.1 million of wealth without paying federal estate or gift tax. Experts think that the Biden administration will look to reduce those exemptions down to $3.5 million per person and increase the tax rate from 40% to 45%. And those exemption amounts and that tax rate are from 2009 levels of the estate and gift tax. So again, not definite, but that's something that they've talked about, and most experts think that that's likely to happen. And to wrap up, two more things we believe they're going to attack are for business owners, the ability to make discounted gifts of shares in a family business for gift tax purposes, and also the ability to use a technique, which I'll talk more about later, called the Grantor Retained Annuity Trust, a way to transfer future wealth to survivors without gift or estate tax. So that's a lot in a short time, but hopefully we'll have time where I can come back and touch on some of these ideas with a little more specificity.
Yeah, we all hope that, definitely. Well, I'd say you checked all the boxes. You said USF, FSU, and UF. So you have some fans somewhere on this call, I'm sure. Jeanine, let's go to you. Speaking of ways to shelter wealth and things that are potentially on the chopping block, can you talk about an opportunity zone for those of us that don't know and what that means?
Best thing since sliced bread. Thank you, Bridget. Thank you, Jason. Again, Jeanine Blake with OppZone Capital. As far as a bio on me, I have a healthcare administration background, turned into portable moving and storage. You might know a company by the name of PODS, Portable On-Demand Storage. My family started that here in Clearwater. We took that company global in about 9 years. got heavy into real estate. Long story short, huge capital gains with all of those sales. And I vowed never to have to do that again if I didn't have to. And everybody has to pay tax, but if there's a way that we can get around that, I'm all for it. So you marry that with the desire to do good for the community. I always going to have a nonprofit, but it just wasn't my bailiwick. So I feel like this is my best contribution to society ever. It's not necessarily a nonprofit, but it gets to marry those two things together: entrepreneurial spirit and community needs, if you will. So an opportunity zone, to answer the question, is basically a new program designed to offer tax benefits in designated census tracts that our governor decides within each state. And what that does is that puts private capital to do public good, if you will. And by doing that, the incentive is to defer your tax bill until 2026, okay? So you get to do that, then you get to reduce that tax bill by 10% if you hold the investment for 5 years or greater. And on top of that, this is the sweet spot. You get to eliminate any capital gains on that investment should you hold that investment for the full 10-year period that it was designed for. So when you think about a huge exit of selling a business or having some type of a transaction, selling an art collection, maybe you're cashing out of some kind of a stock option or whatever it might be, to be able to exit gain-free, and meanwhile you're building real estate in an underserved area and creating jobs, not only to build that brick and mortar, but to add a qualified opportunity zone business inside of that brick and mortar, is kind of like a trifecta, in my opinion. And that's the whole reason I do this. So I liken an opportunity zone to an antibiotic. You're kind of healing the community from the inside out. And meanwhile, you're saving your dollars.
I'm glad you clarified what you meant by that. So staying on that topic a little bit, what changes could be made to the Opportunity Zone program in the new Congress? Is there a chance for a bipartisan agreement?
Well, as it stands current day, it is bipartisan. There are 3 proposed bills out right now, 2 with the Senate and 1 with the House. The differences are pretty minimal. Most of the things that people are asking for, if you will, that those bills are asking for are on reporting, okay? Reporting is key. It's just like anything, right? Research, research, research. We need to take the data in, we need to analyze the data, and we need to see if the program is truly functioning and working. If the reporting shows to the good, most likely the program will be extended. If the reporting doesn't show as such, what should we do? Like in any business, right? We should probably disregard it and move on to something that does work, try something new. The biggest component, though, the difference is removing businesses such as self-storage and or another example would be stadium usage. And that is, those are not huge. I'm just gonna sound a little tongue-in-cheek here, but removing self-storage doesn't create a whole lot of jobs, okay? Self-storage creates a lot of revenue for a municipality, okay? Stadiums create a lot of jobs. So, but you could have a sports team own their own stadium. They could sell their team off. It could be a bit of an abuse, if you will. And just like any system within our government can be abused, that's what they're trying to prevent there. So I think your bipartisan will continue. It's just coming to a meeting of the minds on those small things. Reporting, everybody's going to agree to. A little more stringent under the Democratic viewpoint. Same with the removing of the self-storage and or the stadium type usage. As we stand today, Republican would mostly, it would stay exactly as it is, in my viewpoint, and the other professionals that I work with.
Great, thanks. Derek, I know when we were all talking as panelists, you were on the Hill when opportunity zones were passed. So you're kind of an expert. I just wondered if you had anything you'd like to add.
Yeah, thanks, Bridget. That was a great rundown, Jeanine. And it's exciting to see how it's really working in practice. You know, the idea has been kind of kicking around conservative tax policy circles in DC for years. You know, always looking for ways to harness private capital in in distressed areas. And there have been programs tried before, enterprise zones, the new markets tax credit. Each has their own positives and negatives, but this was a way that they really tried to get let the markets through investors determine how best to allocate that capital. And I like the vaccine analogy there, Jeanine. I may use that if that's okay. But yeah, in terms of bipartisanship, I mean, it had always been, or pre-2017, it had been a bipartisan initiative. In fact, the first bill introduced was equal part Republican co-sponsors, Democrat co-sponsors. It got wrapped into the TCGA, which became a kind of a partisan exercise and passed by solely Republican votes in the Senate, mostly as well in the House. So it kind of got wrapped in that, and so you saw people from the Democrats that kind of back away, but still it doesn't change the bipartisan nature of, I think, how it was envisioned and where it started. And in fact, I talked to a friend of mine yesterday who's been pretty active on this issue back in DC, and he said it's actually part of Vice President Biden's minority outreach initiative. So opportunity zones is part of what they would, I think, ordinarily look to do if he does win the election. You may see some tweaks around the edges, like Jeanine said. The reporting requirements are a big one. Right now they have information on how they're working only to the extent that people are reporting what kind of money's coming into the funds, how it's being utilized. But in terms of the effectiveness of the program, they need more detailed information: what jobs are being created, what's the impact on wages, property values, the kind of things that are the goal of the program at the end of the day. And they had that was in the bill. They had to drop that stuff from the bill because it was that budget reconciliation process I mentioned before, which without getting into the weeds, it's a very kind of arcane means of passing legislation that affects tax or spending. And the way the rules work that trigger that lower threshold in the Senate requires you to drop anything that doesn't have a direct impact on taxes or spending, because that was really more of a policy provision. They had to drop that. But very quickly thereafter, you saw bills introduced to kind of put that back into the mix. And so I think you would see that on the table again pretty quickly. And then also maybe looking at expanding some of the census tracts. I know that was also discussed, although I think there's also an interest in trying to make sure there's a balance so they can have kind of a control group to measure the results versus how it was to actually working on the ground. So, but that was a great rundown.
So I mentioned when we all got on the call that we had a lot of business owners, CEOs, founders, presidents. Carlos, are there income or wealth transfer tax strategies that owners of family or closely held businesses in particular should be considering before the end of the year?
Yeah, definitely, Bridget. As we talked about before, we're going to likely see, if there is a Democratic sweep, control of Congress and the White House, we will likely see some increases in tax. And I may be jumping ahead a little bit here, but as far as the effective date, that could be as early as beginning of next year. So if that's the case, then there's a short window of time between now or election day and the end of the year to perhaps take advantage of the current relatively lower tax structure. So, for business owners, and a lot of this applies to any high income taxpayer or high wealth taxpayer, but for business owners in particular, if there's an idea of selling the business or ownership to a third party, that's in the works, or there would be probably a bigger incentive to complete that sale before the end of the year. Because likelihood is that the ownership in a business, if you're selling shares in a business, that's long-term capital gain. And so, as I said before, the top rate right now is 20%. With the Obamacare surtax, that's 3.8% on top of that. So you're right about 24%. Well, that could double under the if there's a Democratic sweep and that tax change is implemented effective next year. So that would make it even more important, perhaps, to sell before the end of the year. Obviously, you don't want the tax tail wagging the dog, but just something that we like to tell our clients to be aware of, and if possible, all of the other things being equal, might be better to complete the transaction this year rather than waiting until next year. Estate and gift taxes are a big issue right now with our clients. As I said before, right now, it's the exemption under the 2017 Tax Act was doubled, so it's almost 11.6 million right now. It's going to go up next year, if there's no change, to 11.7 million per person. So, a married couple right now can shield over $23 million of wealth. Again, if there's a change in party control, we could see that exemption go from 11.5 down to 3.5 million per person. So that would subject a lot more wealth to the estate tax. And of course, business owners and their ownership in their businesses would become much more susceptible to the federal estate tax. So it might behoove a lot of high net worth business owners to try to transfer ownership of their business, not necessarily all of it, but significant portions, to the next generation. And there are a couple more reasons other than the change in the tax rate and the exemption amounts. There are rumors that if there's a Democratic sweep, there will be efforts to inhibit the ability of business owners to make discounted gifts of shares in a business. So right now, if you own a business that's worth $2 million and you want to give away 50% of that business to your children, the value of that 50% ownership interest, because it's a closely held business and because it's not a controlling majority interest, would be entitled to a couple of discounts. So you could probably, for gift purposes, it wouldn't be a gift of $1 million. It'd be a gift of maybe, 700,000. The ability of business owners to do that has been scrutinized by prior Democratic administrations. And the feeling is that they would revive efforts to attack discounted gifts of family-owned businesses. So something else to keep in mind, we're telling our clients, if they're in a position to give some ownership to the next generation, if there is a change, you probably want to do it before year end rather than waiting.
So I'm curious, Carlos, not to interrupt you, but is it even possible to get that done? I mean, it's almost November.
Yeah, it's tough for sure, but there are ways to do it. With a lot of these gifts, you're not making, our clients aren't making gifts directly to their children. They're making it to a trust. And it's a trust that's off their balance sheet for estate and gift purposes. But for income tax purposes, it's still counted against the owner, the parent, let's say. So you don't necessarily have to complete the actual share transfer in 2020. You can use a placeholder asset like cash. It can even be borrowed funds. And then you have the ability with these trusts to swap assets after the first of the year and not be subject to the new gift or estate tax law, because the swapping of assets of equal value is not considered a gift. So there's a way to get it done. Again, it takes more planning, and it's definitely trickier because there have to be appraisals, but it can be done. It can be done.
So I don't normally go off script, but we got a really good question and I want to make sure that I add that in. So I'll let you guys choose who answers and who doesn't answer based on your level of comfort. But the question is, if a business has a PPP loan, is there any downside to selling the business prior to getting the PPP loan forgiven, i.e. change of ownership issue prior to PPP loan forgiveness? Yeah, I thought it was a great question. Somebody has to answer it. It's not going to be me.
I'll venture, don't hold me to this. I believe I ran across this just very indirectly a few months ago. I believe there's no downside to selling the business before it's forgiven. But to be honest, I can't tell you exactly, but I know that was a question I think one of our clients had, or a similar question. And I think we concluded there was no downside to it. That's certainly something it's worth looking into for sure, but I don't think there is.
I can report back in about a month or two. My mom's business is up for sale right now, and we're walking through that, but we haven't found any downside either.
Eric, anything to add?
No, I think that probably covers it.
Okay. All right. Well, I'm getting you next anyway. We are 1 week away from the election. There's part of me that's like, oh my goodness, and there's part of me that's like, thank God. How do you see the election playing out based on data, based on facts, not based on any agenda or anything else? But what's your opinion on how this is going to go?
Yeah, so I'll just take this as like John Roberts at the Supreme Court. I'll just try to call the balls and strikes here as I see them based on the data. And so I think the best way to do it, knowing we have a bipartisan audience, let me take it from both campaigns' perspectives, okay? So if you're Biden right now, you're thinking, I'd rather be me than Trump, right? The national average of polls has you at about an 8-point lead a week out, right? Which is fairly significant. And a few things make this different than 2016, right? You're an incumbent now, or Trump is an incumbent now, not the outsider. And the polling lead has been pretty consistent, pretty much since July compared to 2016. So that if I'm Biden, I'm looking pretty favorable about that. Now, mind you, we don't have a national referendum. We have an electoral college system. So at the end of the day, as much as those national numbers are relevant, it's the individual states, and particularly the individual battleground states, that matter the most. And for those of you in Florida, here in Ohio, we know and have seen on the TV what that means to be in a battleground state. But there's an interesting statistic from a guy you might follow, his interesting follow on Twitter and on his website, Nate Silver from the website 538. He does a kind of a statistical breakdown of the chances, the correlation between national vote margins and electoral college victory. And he says that if the national lead is 3 to 4 points, which we know it's above that now, Biden has a 74% chance to win. But if that jumps to 5 to 6 points, it becomes closer to 98%. So while you do have to focus on those state polls, the national number is, and the margin is telling. And I would say too, from Biden's perspective, there are a lot of doubts on the polling from 2016. Was it accurate? Is it going to be accurate this time? And I think, I'm not a statistician, but given what the voter turnout numbers that we're seeing right now, they're talking about maybe historic voter turnout. We saw 139 million, I think it was, votes cast in 2016. They're looking at potentially 156 million this year. And so obviously from a statistical perspective, the greater that number is, the likelier that those poll numbers are closer to being accurate. And so then the last point, I'd say if you're Biden, and I try to remind people of this, Trump won a pretty significant electoral college victory in 2016. But if you really look at the numbers, the difference was really only 77,000 votes across 3 states, right? Michigan, Pennsylvania, and Wisconsin. And so and the other thing is he won Wisconsin, but he had fewer votes than Mitt Romney did in 2012. So if you're Biden, you're thinking, okay, he won with an inside straight back then, so things are looking pretty good for me. Now, I'll caveat by that by saying, now if you're Trump, what are you looking at? We got a week left. right? Yeah, the national poll margin is pretty good. It's pretty big. It's been pretty consistent. But you got to look at some of the state polls. And if some of these state polls, he's still kind of hanging in there. I mean, in Pennsylvania, the RCP average, Real Clear Politics, 4.5% Biden lead, pretty much the margin of error, right? Close to it. Florida, as you know, down there, I'd say is about a must win as you can get for Trump. And he's only down there 1.2% on the average of polls. Arizona, another swing state, Biden's up, but only by 2.2%. So you can kind of see, where they see a potential path. And of course, there's a lot of questions about, are these polls picking up these hidden Trump voters? Are they accurate? And, I remember from my days on the Hill, every poll is going to be, it's mostly science, but there's a little bit of art to it as well, right? I mean, you have to be able to create as part of your sample what you think that voter turnout is going to be. And, there's science to it, based on trends and averages and what they expect and, voter input and whatever. But I think if I'm a Trump and I'm arguing that, maybe these polls aren't really reflecting what some of his, support in the, kind of non-college educated community is going to look like. So, and given their registration numbers, which you've seen some news on, they've made some headway there since 16, Trump and the GOP. He's got some things to look at. So I try to call out kind of both sides there for everybody, take, the positive and negatives on both. And then I think, in terms of the Senate and the House, I think, we've seen a trend last few years. You don't see a lot of ticket splitting like you used to. The Senate kind of goes as the president goes. So I suspect that you'll see some of these states that are in play where we have Republican incumbents running, Iowa and North Carolina, Maine, Arizona, Colorado. Those also happen to be a lot of, swingy states. And so if you see those numbers kind of tilt toward Biden, you may see the movement toward the Democrats and kind of vice versa. And I'd be happy to talk individual races, break down the numbers further for anybody that wants. I've been kind of watching those races pretty closely. And then last, the House, I just don't see much of a change there. You probably see in the news there. And if anything, I think Speaker Pelosi probably will see her margins increase there from anywhere between status quo to maybe 10 to 15 seats. So it might not be an encouraging night for Republicans in the House.
Got it. So Carlos, and I'm going to read this one so I don't mess it up. If there is a Democratic Party sweep on November 3rd, i.e. Biden-Harris win the White House and the Democratic Party wins control of the Senate and retains control of the House of Representatives, how soon would any change in the tax laws likely take effect?
Good question, Bridget. So, as Derek, certainly knows, there are a lot of moving parts, and it's not necessarily a given that if there is a Democratic sweep that they will be able to pass what they want when they want necessarily next year. But we're taking the position, just planning for in the event of a tax increase that we would expect with a sweep, that what's the earliest that it could happen. So, obviously inauguration is not until late January. The likelihood is that if the Congress and White House are able to get their tax agenda passed in 2021, it'll likely be closer to the end of the year. However, they do have the ability to make those changes retroactive. And so that's what we're telling our clients, is to assume that any change could be retroactive to January 1 of next year. Obviously, that's not necessarily, it might be later, but it's better to plan on the assumption that it could be effective January 1. Now, there have been cases where, and there's nothing to say that a tax increase of an existing tax, whether it's income or estate and gift, cannot be made retroactive into a prior tax year. However, I think most of the experts believe that if the Democrats do make a change in late 2021, it would likely go back just till January 1 of 2021. So anybody who wants to take action to save taxes would need to do it by year end 2020.
Got it. Jeanine, what's next for opportunity zones? What do you see in the future there?
Well, I do think that the reporting changes are going to happen, right? I think that potentially the zones might change, much like Derek said. I think that you're going to see an increase in capital gains is going to kind of flood into the OZ sector very soon. People are at a deadline. When they pushed everything out to the end of December, I think you're going to see a lot of money moving around. And I think the program, again, I think it's good for both parties. I think it's going to expand. I think we're going to see a lot of good come from this. As people learn more about opportunity zones and the benefits that they offer, they're going to be a little more apt to put their money there. They'll see the return on investment. The communities will thrive, and all around, I think you're just going to see a betterment for everyone.
Great, thank you. All right, this is the last question I'm going to ask, and I'm going to ask it to whoever is most qualified and comfortable answering it. And unfortunately, I don't have that in front of me at this time. I think I know who it is, but I don't want to guess. In the event of a Democratic Party sweep, I have heard that wealthy married couples can use a special type of trust that's called a SLAT, which stands for Spousal Lifetime Access Trust, to lock in their current estate tax exemption. Anybody have more details or can elaborate on that?
Yeah, Bridget, this is Carlos. I'll take a stab at it. So as I mentioned before, we're looking at potentially a drop in the gift and estate exemption from 11.5 to 3.5 million starting next year. So if you're in a high net worth situation and you do nothing in 2021, you will have lost the ability to transfer about 8 million of wealth to the next generation free of gift or estate tax. So what a lot of our clients are doing is trying to, in the event of a sweep, lock in the current higher exemption amount, the 11.5 million. Or what's left of it. So some clients have already used up that amount with prior gifts, but whatever's left of it, or if the entire amount, if you haven't used it, would need to be used by year end in order to take full advantage of it if there's a reduction starting next year. So that can take the form of just an outright gift to your children or grandchildren of assets equal to $11.5 million. That's per spouse. So as a couple, you can transfer 23 million, over 23 million free of gift tax. However, most high net worth individuals don't want to part with that much wealth in one fell swoop. So married couples are in a position where they can move that money, that 11.5 million per spouse, off their taxable balance sheets, but not lose complete access to it. And so the way they do that is, let's say husband has 11.5 million, he puts it into a trust that is designed where it's irrevocable and it's creditor exempt, but the beneficiaries of that trust include wife and the couple's children. But the trust is drafted in a way where the assets in that $11.5 million trust for wife are not counted on her balance sheet, whether for creditor purposes or for estate and gift purposes. So as long as the couple continues to be married and on good terms, the husband who donated the assets to that trust indirectly has access through the wife. And likewise, the wife can create a trust of 11.5 million for the husband's benefit and maintain some indirect access as long as they abide by the terms of these trusts. So that's what we call spousal lifetime access trusts. It's a way for couples to lock in their exemption, but not lose complete access to the funds, and still, get those assets off their balance sheets for estate and creditor purposes.
That was a great explanation. Even I understood it. So that's saying a lot. Well, thank you guys. I mean, thank you to the people in the audience, obviously, that joined us. These virtual events, although we all have Zoom fatigue, our attempt at continuing to bring you information that you can't get anywhere else, and relevant information that you can use in your business and in your personal lives now. And I'm really proud of not only this panel that we were able to assemble, but just our panels in general. So thank you to our sponsors and panelists, Jeanine Blake, Principal CEO with OppZone Capital, to Derek Harley, SVP of Federal Affairs with Shumaker Advisors, all the way from Toledo, Ohio, and Carlos Rodriguez, SVP and Wealth Strategist for Bank of America Private Bank. Thank you to all of you in the audience for joining us and for sending some great questions in. We have asked the panelists to stay on. Some of you have experienced what happens at 5:30, everyone grabs a cocktail and we have a live conversation and some networking. And I know we're all missing that to a certain degree, and this is as close as we can get in some cases. So we will stay on. You are welcome to stay on. The panelists are going to stay on as long as they can, and they're willing to answer your questions live. As far as TBBW goes, please make sure you're following us on Facebook, LinkedIn, Instagram, Twitter, wherever, and that you're signed up for our newsletter that we send out twice a week. And we just appreciate you very much for being here and hope that you learned something today and that we helped you be a more educated voter and maybe saved you some money at the end. So with that, Jason will open up everybody's mics. I am going to shut mine down, and you might not hear from me again, but thanks all of you for being here and being a part of this important conversation.